Path podcast. I'm John Williams, flying solo here today to bring you a topic that's been in the news quite a bit recently, and that's the oil industry. Whether it be what's going on in Russia and how that's affecting the prices of crude oil, the rapid rise of gasoline and fuel. And I've also noticed that I've been having a lot of conversations around the industry, and I've seen a lot of opinions flying around. So I thought it to be relevant and a good topic to kind of talk about just the industry in general, the supply chain, how prices of oil and gasoline are set, and a lot of the things that you really just need to know to understand not just what we're seeing today and how that is coming to be, but what is really underneath the hood and what is really causing these fluctuations that we've seen, not just recently but really over the course of our lives, and quite frankly it's probably not going to be the last. So I thought I'd start with just a little bit of a rundown of the supply chain and just unpack how the oil really comes out of the ground and really gets ultimately to your car. And there's, at the highest level, three distinct parts of the supply chain of oil, and that is, the first one is going to be the upstream, the second is going to be what they call the midstream, and the third is going to be, as you could probably guess, the downstream. And the upstream is really the exploration and production. It's finding the oil and drilling and pumping. And the second, which is the midstream, is going to be the transportation of the oil from the wells. Once you have it pumped to the refineries, and once it gets to the refineries, it's considered in the downstream, which is going to be refining and the sale of the finished product. So to start with the upstream, just a few interesting things I find interesting about the upstream and the exploration and production of oil is really just how hard it is to find, and the distinct characteristics and how many things have to be present in order for there to be a well that's going to be economically efficient enough for a company to continue to continue to drill and continue to pump the oil. The first thing is really going to be a source rock, is what they're calling it, and the source rock is going to contain ancient microorganisms, and it has to contain enough of these microorganisms, and it has to actually exist at a temperature within what they call an oil window. So it has to be the perfect temperature. It has to be, those organisms had to have been there long enough at that temperature. Also, there has to be a rock that's porous enough above that source rock where the oil can then form from that source rock and actually seep through the rock above it. And then above that, the porous rock, you have to have what they call a cap rock that's going to then trap the oil into what will ultimately be the reservoir of crude oil and natural gas. Now, to make matters even from an exploration perspective even more complex, is this is all happening 3,000, 6,000 feet below the surface of the earth. And in most cases, in a lot of cases, above where the drilling starts at the surface of the earth is water. The drilling and exploration is happening offshore. So now you have the water, sometimes thousands of feet of water. You have the 3,000 to 6,000 feet down to where the reservoir would exist. And now you have people on the surface of the earth trying to find where this is. And as you can imagine, it's extremely hard to find where these sources are. So the exploratory part of the business will be very, very, very technical. There's very, very technical tools that these scientists have to try and track down where the possibility, in air quotes, of the reserves of oil will exist. They use one of the tools I saw involves seismic data, But I don't really want to go into necessarily the specifics of that, but I think that the takeaway there is there's a lot that goes into even just finding the possibility of oil, and then even though you find this spot where you think there might be oil, there's no guarantee, of course, and there's depending on where you are, there's going to be a probability of there even being nothing, and there being a dry hole, and you just plugging it up and going on your way. The problem is to really, really know whether there's oil in a spot where you suspect there might be. You have to spend millions of dollars to drill to find out for sure, and as you can imagine, that's a big risk. And so let's say, for instance, you get to the point where you drill and you do find that there is oil. The next step will be, so now you're already in for a few $1,000,000, and not to mention to even start to drill, you actually have to get the mineral rights, or lease the mineral rights to that area. The mineral rights is basically going to be everything below the surface of the earth, and it's not really economical for these businesses to buy the rights, but so they'll lease them from the owner. Sometimes the owner is the government, as you may have heard on the news of governments and giving contracts to companies to drill. This would be ultimately that company signing a lease agreement with the government to be able to drill in that area. But sometimes there are private mineral rights owners, but the other part of it, there's a lot of, as you can imagine, a lot of technicalities that go along with the lease. But one of the things I want to point out is that typically in that lease, there's going to be a royalty that's going to be owned to the mineral rights owner as part of that lease. So I want to drill in a certain area. I find out who the mineral rights owner is. I work out a lease agreement with that person. We agree on what a royalty would be. That royalty is going to be a percentage of the revenue from the drilling that I do. So now I find a site that I think might have oil. I get ready to invest millions of dollars to drill to find out if there actually is oil. And I also have a bill that I've already agreed to before I even find oil. That's going to be a royalty. So there's a lot of upfront, just capital investment into finding oil before you even have the possibility of getting that money back. So there's a ton of risk involved in the beginning. Two ways that there's, just as an example, if there's going to be really kind of separated, in the exploration is going to be separated into two different areas. There's what's really going to be the exploration that's going to be far away from where they've even found any oil, and there's going to be the areas that are closer and to where there is currently oil. And those areas where there's currently oil, the percentage that there is oil in those areas that the scientists find the possibility of the possibility of these reservoirs is going to be much higher than some of those other areas, but it could run anywhere from 20 to 80% probability when it comes to the exploration. So again, really, really high risk. And then let's say you do find a reservoir that is worth continuing to pump. You start pumping the oil. Now you're in the midstream. You have to find a way to get it to the refineries, because the crude oil is a very raw product. So there's going to be a lot of products that are going to come from the crude oil, but you have to get it to a proper refinery to actually to separate it into the products that ultimately will end up at the end user. Today I'm going to focus more on gasoline and transportation fuels like diesel and gasoline, but there's a lot of products that come from crude oil, plastics, jet fuel, kerosenes. There's almost every type of gas almost you can think of, but there's a lot that's going to come from them. But the refinery will take the crude and put it through a distillation process that's going to heat up the crude and then cool it down. And as it's cooling down, they'll siphon off these different materials, one being gasoline and diesel. And once that process is finished, it then gets distributed to gas stations and the different points of distribution from there. So taking a step back on crude, one of the things I feel like one of the misconceptions that's out there when I see people who have things to say or different opinions about the topic is they're misunderstanding that all crude is really created equal, and there's quite a difference between crude oil depending on where you get it, and the distinction between the different types of crude will be in the difference of what they call sourness, or sweet versus sour, and low and high viscosity. So oils that are high in sulfur are considered sour, and oils that are low in sulfur are going to be considered sweet. And then the low viscosity is going to be the oil that they call light, and the high viscosity is when they call heavy. So the oil that is the most sought out and the easiest to refine, and the easiest to get some of the higher quality products out of, is going to be the light and sweet products, versus the high sulfur and high viscosity products that are going to be harder to refine. There's more sulfur that you actually have to pull from the product. So as an example, there's benchmarks that you may have seen or may have heard that the industry uses. The two most popular for price are going to be the WTI and Brent, and those prices reflect those types of crude, and those types of crude tend to be light and sweet relative to the overall supply. So anything that is going to be low viscosity and sour relative to WTI and Brent are going to be sold at a discount, because they're going to be less desirable, and they're going to require more work to get the same result that you would get from a light and sweet product. So you can imagine, and depending on where you're getting the oil from, there's going to be different types of oil that are going to come from different areas of the world. As you can imagine, something like that is greatly going to affect how much, what the cost of oil is going to be, because there's finite production on a daily basis, and as that production goes up, the only way for there to be more production is going to be for companies to buy some of this oil that is going to cost them more to produce some of the final products. So there is going to be that, because as you can imagine, the light and sweet products are going to be sought first. They're going to be the easiest to the ones that are going to be, people are going to buy first. And then as demand goes up, assuming that the supply in all the different areas of the world remains the same, the only way, if you need more oil, you're going to have to then go to some of these less desirable oils, and that's going to cost you more from an overhead perspective, because you're spending more money to pull some of these products from the crude. The other interesting aspect of price is going to come from really where the oil is pumped. And different parts of the country, I should say really different parts of the world, and how the oil is going to be drilled and pumped is going to affect how much the oil costs. So, at any given time, there could be a range, a really wide range. So, like if we see let's say the median is about $80, there could be some oils that are costing $120 per barrel, and there's going to be some that could be costing $60 per barrel, and obviously that it all averages out. So there may be one region of the world where it's really inexpensive to drill, and it's maybe it's a little bit more accessible, and so that the price per barrel there is going to be a lot lower than, let's say, somewhere that might be really deep sea, really hard to drill, and just a little bit less accessible. So there's going to be a wide range of where the oil is going to come from, and as you can imagine, that's also going to be a factor, because if you want to, your first choice is going to be buy the oil that's the easiest and the least expensive. But again, the supply is not, is finite in those different areas at any given point in time. So, as the demand goes up, companies are going to be forced to buy from these less desirable parts of the world, and again, driving up the price. So from there, I want to talk a little bit. I already mentioned WTI, which is Western Texas Intermediate and Brent, and those being like the standard for, or not necessarily the standard, but the benchmark for these oils, and how that price that you're seeing and how it fluctuates is going to kind of really be a basis for all the oils and how they're fluctuating. And that part of gasoline is going to be roughly 50% of what you're seeing at the pump. So let's say you pay $4 for a tank of gas. The $2 of that is coming from the cost of the crude. And then the other $2 are going to come from a lot of different things like taxes, marketing, transportation, and all these other things that are going to go into the production and transportation of the product to the end consumer, typically at a gas station. And the gas station owner is really going to be seeing a profit from the gas at the pump at about 5 to 10 cents. Obviously, not a lot, and from what I read is a lot of these gas station owners are not relying on that for their main revenue, and they're really looking to the convenience stores that are on the property to widen those margins and increase their revenues. So like when you go to I think there's been a lot of talk recently as to like these gas station owners and how they're a part of this problem, but I don't see any proof of that in my research. So that brings us to some of the things that are going on today, and some of the things that we're seeing in the fluctuations, and a lot of that is going to come down to supply and demand. So a couple of things to look at here is, in the simplest sense, when you look at supply and demand, obviously if supply goes down, demand goes up, the price is going to go up. So when you have the oil steadily, the demand for oil has steadily gone up, really in the last for decades. There have been a few moments where the demand has gone down, one being the pandemic, the other being in 2008, where people were just across the board pulling back on spending. But for the most part, you've seen this steady rise in the demand for oil products, and you've seen little. You've seen this demand being very, very inelastic to the price of the products, which can almost be disturbing. And what that means is, even as we sit here right now, people are complaining about gas going to $4.50, but it has very little effect on people's behavior. You would think that oil would skyrocket and you would see people buy less of it. Now, to a less extent, sure, they might be buying a little less, but it's not affecting, it's not that, it's really inelastic. And And what that means is we're really not seeing really just the human behavior changing, and their habits of buying gasoline going down, and it's crept up steadily. The biggest problem with that is really obviously we need to keep up with the this increased demand, but as I mentioned before, that as we increase as this demand increases, we need to find the oil somewhere, and if production can't increase fast enough, we're forced to look to these other areas of more expensive oil sources, whether it be fracking or some of these just other areas of the world where the oil is more expensive, the less desirable oils to get refined. And the other part of it is also the fluctuation in demand and the lagging of production increase, or the ability to increase production behind some of the drop in demand. And I'll use the pandemic as the example. When the pandemic really hit back in 2020, March of 2020, when everything shut down, the oil industry followed suit and really pulled back production, because not only did we see a drop in demand, but we expected the demand to go down with all these lockdowns. So now you have these refineries, they're looking at what at the time was roughly, let's call it 20 million barrels per day of oil was our demand at the time. And let's say that drops to 10 million barrels. The oil industry needs to because there's a big loss on their books if they can't pull back fast enough, which I get, really it's they really can't react fast enough, but the idea is that they need to pull back and not be overstocked, and really kind of follow that demand drop as much as they can. And through that, there may be some small businesses that went out of business, refineries being shut down, and then this whole chain that I spoke about in the beginning of the podcast, of the supply chain of exploration, looking at different ways, maybe more pipelines to get the oil from the from the drilling site or the pumping site to the refinery. And I did mention that those are the two main ways, would be to ship the oil via tanker, or a pipeline, which they're obviously all over the world. And maybe they shut down a pipeline, maybe there's they put ships out of commission. There's the entire chain is affected now, because when you shut off production and you see there's not as much demand, it's basically going to start at that downstream, and it's going to run all the way down. So the unique nature of the pandemic, of it shutting down so quickly and then coming back so quickly, unfortunately, as the demand has come back tremendously, it's even higher than it was before the pandemic. Production has not been able to, and it never, even if it was full force, it couldn't come back as quick. And we saw an increase in demand, increase in production in the U.S., but it hasn't gotten anywhere close to what it was pre-pandemic. Let's say pre-pandemic, it was about 13 million barrels a day of production, and right now we're like right around 11 and a half, let's call it. It might have been 13 and a half, but so a couple things going on here. One is they're just not able to catch up and bring production. It's not like flipping a switch and saying, all right, make another 2 million barrels per day. They have to get this whole chain going. So they have to start the exploration, maybe get refineries back online. But there's also the idea that these companies, they're not necessarily looking 100% at what's going on today, but they're trying to predict what the demand is going to be months from now, and even sometimes years, and a lot of that is hinging upon the supply chain. Are they going to take the big risks, even though they have these leases? And you may have seen heard in the news that there's 9,000 leases that a lot of these companies stockpiled on before Biden came into office, that they haven't really used. Well, a lot of that is the uncertainty in the marketplace, and there's a lot of uncertainty, and these oil companies got extremely burned in certain cases where, the demand dropped off and production was high. One being the pandemic. I think a lot of people don't realize that the oil industry saw losses for the last 10 years. And 2 years ago, because of the pandemic, they saw a loss of $76 billion. Now, I'm not saying this because I want you to feel bad for the oil industry, but what I'm saying is that these are real people investing real money into this business. There's investors who behind these companies who are reluctant to encourage, or use their voice to encourage production to come back too quickly, because let's say for just as a for instance, there is another bad variant that comes out that forces another shutdown, or let's say there's legislation in the federal government that's not favorable on the oil production, or I think you can kind of get the point that there's enough uncertainty where it's really hard for them to just say, all right, let's really, really get behind this and really pull the production back as quickly as we can, and maybe even get past where we were before. So I think you're seeing a little bit of a slower comeback with production, even more so. And I haven't even mentioned Russia. I mean, that's even a whole nother, problem. I mean, obviously, it's for lack of a better word, when it comes to uncertainty. And if you watch it in the news, it's day by day. Who knows where this is going to go? And Russia being such a big part of the equation. And I don't really get the impression that these oil companies necessarily want to take advantage of these high prices. I think they would rather there be stability and know it, and a little bit more certainty in knowing what the market could look like, and having a little bit more control because of the risk that goes involved with the upfront investment and continuing to grow the business, and be in these different spaces. So I think that's really when it comes to the rise in prices. What we've seen is obviously seen a really big jump over the last month, but we've also seen a rise in gas prices really since things started to come back. And I think that a lot of it is just that lagging production, and then of course with Russia being such a large producer, the speculators and those who are in the business are just really, really worried that that's going to send the supply extremely low, because they're such a contributor to that overall worldwide supply. Now, that brings me to the political part of this conversation, and as I sit here and try to put myself in the middle and just try to understand both sides, I think one of the problems with how politically charged this has been is it's really hard to find really good information, and really information that's going into enough detail where you can understand what the point they're trying to get across, as opposed to just saying, oh, well, Biden shut down the Keystone pipeline, and prices are rising. Now, if you don't understand the oil industry, you might take that literally and say, oh, well, yeah, that makes sense. Why aren't we pumping more oil, or why aren't we doing more to try and lower gas prices? With that said, I do think that heavy is the head that wears the crown, as they say, and I think we do look to leadership to try and help come up with solutions, and whether it be sitting down with these oil companies and see if there's a way that we can have our cake and eat it too when it comes to environmental initiatives. Like it never ceases to amaze me that it seems that you can't support the oil business but also want to have push forward these environmental issues that are out there, and I don't necessarily find that to be true. I don't see any reason why we should hurt the economy by hurting the oil business to try and push forth these environmental initiatives. I don't see any reason why they can't happen at the same time. Now, I understand there's optics. Like, for instance, if Biden was to sit down with oil companies, maybe that's bad, and whatever. Politics is politics, but I do think that there could be some things that could be done to encourage or just encourage or just entice these investors or companies to go full steam ahead and try to get supply back on track, so we can normalize the price of oil and the price of gasoline, all while continuing to maybe make some steps towards electric vehicles, and some research into sustainable energy, and I think that the part of what we need to continue to consider is that both those things, I think, can exist at the same time. Well, that's all I have for you this time. If you have any questions or comments, please feel free to email me at john@bautisfinancial.com. That's john@bautisfinancial.com. Please don't forget to subscribe, and thanks for joining me.